Welcome to REIT Magazine's weekly report. I'm Matt Bishard.
And I'm Alan Kenny. In our first story this week, ratings agency Fitch Ratings reaffirmed its stable outlook for the REIT market. In a look ahead to 2013, Fitch said access to capital, liquidity, fixed charge coverage, and strengthening property fundamentals are all positive signs for equity REITs. Stephen Marks, managing director with Fitch and head of the firm's REIT group, did warn that REITs need to keep watch of the looming fiscal cliff.
Certainly the fiscal cliff, and creating a lot of uncertainty in terms of companies choosing or not choosing to make decisions this year and into early next year. The second thing is just more broadly the economy. The economy ultimately drives demand for commercial real estate, and if the economy continues to bump along slowly, then commercial real estate, probably with a 12 to 18 month lag, will bump along slowly as well.
Commercial mortgage-backed securities are benefiting from stability in the financial markets, according to a recent report from analysts at JP Morgan. Yields on CMBS have narrowed 30 basis points to 145 basis points since the middle of November. It has made for the tightest spread since mid-2008.
International real estate firm Hines announced that it is developing the United States' largest carbon-neutral building. The 13-story, 415,000 square foot facility is under development in San Diego. It will be what is known as a net zero building, one that produces as much power as it consumes and has a carbon-neutral footprint. The site will include 3 fuel cells running on carbon-neutral biogas 24 hours a day, 365 days a year.
Although the commercial real estate recovery has proceeded slowly, NAREIT Vice President for Research and Industry Information Calvin Schnoor says he expects growth rates for REITs to continue to climb. In the December 2012 edition of Fundamentally Speaking on REIT.com, Schnoor discussed his outlook for REITs in the coming year. The lack of new construction is playing to REITs' strengths, according to Schnoor.
Very reasonably, most developers cut back quite a bit on their projects in the midst of the recession, and many of them haven't started up again. We are seeing some improvement in multifamily. Of course, there are a lot of stories about multifamily supply coming along, but this chart shows the reason why in the overall national picture, new supply is really not a worry. So you put these two features together, the economy continuing to gather speed and new supply really lagging behind. And what that suggests is that commercial property across most property types should be seeing rising occupancy, rising rents, and rising prices.
That concludes this edition of REIT Magazine's weekly report. We'll be back in 2013.
In the meantime, be sure to stay up to date with the latest commercial real estate news at REIT.com as well as realestateinvestmenttoday.com. Happy holidays.